So when it comes to patterns, we have hundreds of patterns in trading. You can browse through your phone and you'll see different patterns. But in this video, I'm going to explain a few popular patterns you ought to know as a forex trader, which are these patterns you see here: the double top, double bottom, head and shoulders, inverse head and shoulders, rising wedge, falling wedge, bearish flag, and bullish flag. So without wasting much of the time, let's explain these patterns one after the other. So this is the double top. So this double top is like the market goes up and then goes down and then goes up again, creating two equal highs and then goes down. So if you see from this point, market goes up, goes down, goes up again, creating two equal highs. You can see this high is equal as this high, so the market goes down. So now you see a double top formation in the market because this is a pattern. This is double top because it's literally two ups. So now you see this double top in the market. What do you expect next? This is where we expect a breakout through this neckline. This is the neckline of the double top, so you wait for a breakout below this low, below this trend line, and then this is where you enter for a short position. Why? Because the market is about to reverse to the other side. So this is where we enter a short position, stop loss, and then take profit to the downside. So wait for market to go directly to our take profits. Sometimes the market may want to retest the neckline, like go down and then goes up a little to retest the neckline before going down. But most time the market just go down. So this is how double top works. The market goes up, creating two equal highs, and then we wait for price to break below the neckline before we can enter for a short position. This means we're selling the market. So the opposite of a double top is a double bottom. So if you can see right here, the market goes down and then goes up and then goes down again, creating two equal bottom, and then goes up. So this point, we just do same thing but the opposites. We just wait for market to break this neckline we just drew here before we enter a long position. You can put your stop loss and then take profit to the upside. So this is how double bottom works. Just like the double top, it's just the opposite of it. Market goes down, goes up, goes down again, creating two equal lows, and then goes up to the neckline. So you wait for market to break this neckline before you can enter a long position. So this is how the double bottom works. And now let's go over to the head and shoulders. So now this is the head and shoulders, and as you can see right here, the market goes up, created a high, and then goes down, and then goes up again, creating a higher high, and then goes down, then goes up. This is a lower high because it's lower than the other high, so goes down. So this is called head and shoulders. This is the right shoulder, this is the head, and this is the left shoulder. So we draw a trend line and then we wait for market to break below our trend line before we can enter a short position because the market is about to go down. So this is where we enter a short position, stop loss above a high, and then take profit to the downside. And this is where we wait for price to push to the downside to our take profit. Sometimes, like I told you before, the market may want to retest the trend line before going down, but sometimes the market just goes down to the downside. So this is how head and shoulder works. Goes up, creating right shoulder, and then the head, and then the left shoulder, and then we wait for price to break below the trend line we just drew. We drew this trend line. This is not in the market. We drew this trend line, this line right here. So we wait for market to break below this trend line before we can enter a short position because the market is about to go down. So this is how head and shoulder works, and I'm going to take you to the next one, which is inverse head and shoulders. So this inverse head and shoulders is just the upside down of head and shoulders. As you can see, it's called inverse head and shoulders. So it's just the inverse of head and shoulders. So it's just as simple as that. So the market goes down, creating a low, goes up, and then goes down, creating a lower low, goes up again, and then higher low. So at this point, what do we do when we see an inverse head and shoulders? Because this is an inverse head and shoulder. This is the left shoulder, and this is the head, this is the right shoulder. So it's just like the upside down of this head and shoulder right here. So this is the inverse head and shoulders. So what do? We mark out our trend line, or you can say neckline. This is the neckline of the head and shoulders. But this is a trend line. It's called a trend line. So we mark out our trend line and wait for price to break above our trend line. And this is where we enter for a long position because the market is about to go up. You can put your stop loss below this high, or if this is the bigger time frame, you can go over to the smaller time frame to search for a comfort place for your stop loss, and then you send your take profit to the next high. So this way you wait for price to push to the upside straight to our take profit. So this is how inverse head and shoulder works. Market goes down, creating lower low, then goes up, then goes down again, a lower low, and then goes up, and then a lower high. You mark out your neckline and you wait for price to break above the neckline of the head and shoulders, and then you enter for a long position because the market is about to go up. So this is how inverse head and shoulder works. And right now we're moving to the next one, which is the rising wedge. When it comes to rising wedge, this is what the market does. Market goes up and then goes down and then up and then goes down, trying to squeeze out from a little channel. And then when we see this in the market, this is called a rising wedge. The market just keep consolidating to the upside, and then this is where we mark out our trend line at the top and down, and then we wait for price to break our trend line, which is below this last low right here. This is where we wait for price to break down. After we see the break of structure to the downside, this is a break of structure to the downside. The market broke our trend line to the downside. This is where we enter for a short position. If this is the bigger time frame, you go over to the smaller time frame to find a unique place for your stop loss and then take profit to the downside. And then this will wait for price to push down to take profit after breaking this trend line. So this is how rising wedge works. Market goes up, goes down, goes up again, goes down, goes up, goes down, trying to squeeze out of a little channel or something, and then the market breaks our trend line, and then this is where we enter the short position, take profit to the downside, and we expect the market to go down to our take profit. So this is how rising wedge works. And then let's go over to the next one, which is the falling wedge. So the falling wedge is simply the opposite of the rising wedge. The market goes down, just same thing the rising wedge did. The same thing the rising wedge did. This is the falling wedge. It's literally falling, so that's why it's called falling wedge. So the market is going down, consolidating to the downside. It's like it's consolidating through a very tiny space. The space is just getting little and little. And then what do we expect from this point? This is where we expect price to break through the trend line, give us a break of structure. This is a break of structure right here to break through the trend line. So when we see a falling wedge, this is where we enter a long position. Like I told you before, if this is the bigger time frame, if you spotted this falling wedge in the bigger time frame, then you can go over to the smaller time frame and find a comfortable place for your stop loss and then take profit to the next swing high. So what do we expect the market to do at this point? We expect the market to go straight to our take profit, because this is what the market is going to do next. So once again, this is the falling wedge. As you can see, the market goes down, made a consolidation to the downside, like it's trying to squeeze out of a little channel, and then when it finally breaks out the trend line, this is where we enter a long position. This is a reversal pattern, so we enter a long position. What do we expect the market to do from this point? We expect the market to go straight to our take profit. So this is how falling wedge works, and it's just simply the opposite of a rising wedge. So let's move over to the next one, which is the bullish flag. Bullish means a market that is going up. So you should know this too. Bullish means a market that's going up. It's called bull because when a bull wants to attack a person, it attacks you from down to up. Like when a bull wants to attack a person, it literally attacks you from below and then to the upside. Then bearish is derived from the bear. So when a bear wants to attack a person, it attacks you from up to down. Do you understand? So that's why it's called bearish. Bullish is the name of a market that's going up. Bearish is the name of a market that's going down. So this is a bullish flag. So it's called a bullish flag because the market is about to go up. And somehow this bullish flag looks like a falling wedge, but no, it's not a falling wedge. It's a different pattern. It's called bullish flag, and the difference is this one is trying to squeeze out of a tiny hype channel or something, but this one is just free. So this is a bullish flag. Why is it called a bullish flag? This means the market is about to go up. And if you take a good look at this, it's literally looking like a flag. You see? It's looking like a flag. So nothing fancy, nothing complicated. If you notice very well, the market goes up, higher high, and then market started consolidating to the downside, lower lows and lower highs. So at this point, when we see this is a bullish flag. This is where we mark out our trend line at the top and on the downside. So what do you expect from this point? We're expecting the market to break through our trend line, giving us a break of structure. This is a break of structure because this high just broke this recent high. This is the new high and this is the recent high. So this is a break of structure and it also broke the trend line. So when we see this bullish flag, we're expecting the market to break through our trend line. This is where we enter a long position because the market is about to go up. This is called a continuation pattern because the market has been going up. The market just did a little bit of consolidation to the downside, and then we're expecting the market to go up. So when the market gives us a break of structure, the market broke our trend line. This is where we enter a long position and then take profit to the next swing high. We are expecting the market to go straight to our take profit. We are expecting the market to go up because it's a bullish flag and the market is going up. Do you understand? So if you don't understand, I will explain again. The market goes up and then goes down, started consolidating to the downside, and all of a sudden we have our bullish flag. It's looking like a flag. So what are we expecting from this point? We're expecting the market to break through our lower high, giving us a break of structure, and it also broke the trend line too. So this is where we enter for a long position and we're expecting the market to go straight to our take profit. So this is how a bullish flag works. And other one we have is a bearish flag, which is simply the opposite of a bullish flag. It's like the upside down of a bullish flag. So take a look at this. It's literally looking like a flag, but it's upside down. So when we see a bearish flag, this means the market is about to go down. The market has been going down and the market just made a consolidation to the upside, and then we marked out our trend line at the downside and at the top. This is when we wait for price to break through our trend line, or we say to give us a break of structure, and then this is where we enter for a short position. If you found this in the smaller time frame, you can put your stop loss above this high and then take profit to the downside. But if this is the bigger time frame, you can go over to the smaller time frame. You look for a price, you can play your stop loss and then you take profit to the downside because the market is about to go down. The market has been going down, started like this, then consolidated to the upside, and we're expecting the market to go down more. So this is where we enter a short position, and what do we expect? We expect the market to go down to our take profits. So when we see a bearish flag, this is what we're expecting. Market goes down, goes up, making consolidation to the upside, and then we marked out our trend line. Then we wait for price to break below, giving us a break of structure and breaking our trend line also. And then this is where we enter for a short position. Then we're expecting the market to go straight to our take profit. So this is how the bearish flag works. And if you notice these patterns right here, this double top is a reversal pattern. As you can see, the market started from here. This means the market is in an uptrend. Market goes down, trying to go higher, but no, market goes down again, and then the market reverse, and then we're expecting to sell this market because we have seen a double top. So this is a reversal pattern. This is a reversal pattern. The market has been going down, but now it's about to reverse. And then head and shoulder is a reversal pattern too. Inverse head and shoulder is a reversal pattern because the market goes down and now is about to go up. Rising wedge is a reversal pattern because the market has been going up, now is about to go down. Falling wedge is a reversal pattern because the market has been going down, now is about to go up. The bearish flag is a continuation pattern. Why do I say it's a continuation pattern? Because the market has been going down and now it's just like taking a break before it goes down the more. Same for the bullish flag. The market has been going up, we're in an uptrend, and then the market just consolidated to the downside, taking a little break before heading to the upside again. So this is how these patterns works. The double top and the double bottom, head and shoulders, inverse head and shoulders, rising wedge, falling wedge, bullish flag and bearish flag. Like I told you before, we have hundreds of patterns. You can browse through your phone and you see different patterns, but these patterns I'm showing you right now are the popular patterns you ought to know. As a forex trader, you ought to know this, because if you don't know this, it's like you don't know the basics of forex. So these are the patterns you ought to know as a forex trader. So right now we'll be moving over to the main chart, so I'll be showing you these patterns: the head and shoulders, the rising wedge, the falling wedge, inverse head and shoulders, double top, double bottom. I'll be showing you those patterns in this chart. So one thing you should always know is that you can find these patterns anywhere. You can find this pattern in the 15 minutes, you can find them in the 5 minute, you can find them in the 4 hour, you can find them in the 1 hour. Sometimes the bigger the time frame, the stronger the pattern. For example, you see head and shoulders in the bigger time frame, in the 4 hour time frame. So this means the market is about to reverse, and it's really gonna reverse because it's the bigger time frame. Because the bigger time frame shows us what is going to happen next. So right now, let's go over to the smaller time frame if we'll see a few patterns. So as you can see right here, take a look at this. So taking a look at this, taking a good look at this, this is a fallen wedge. How do we know it's a fallen wedge? Take a look at this. Market goes up, goes down, goes up, trying to squeeze out of the little channel, and then so this is a fallen wedge. This is how the fallen wedge look like. So this is where we wait for the market to break our trend line. As you can see, the market broke the trend line, and this is where we enter a long position. Stop loss, then take profit to the upside. When you're targeting your take profit, you shouldn't take it so high. You can take our profit around this area. So as you can see right now, the market goes down, goes up, goes down, giving us a falling wedge. And then the market broke the trend line. This is where we enter for long position and then take profit to the next swing high. This is your swing high. And then within 10 minutes, the market moved. So this is the 5 minutes time frame. Each candle here represents 5 minutes. So this one candlestick represents 5 minutes and this one represents 5 minutes. So within 10 minutes, the market goes up to our take profit. So this means our falling wedge really worked out. So let's say we got lucky and then we took all this profit to ourselves. Market gave us a falling wedge and then we entered for buy position and then the market goes straight hitting our take profits. So let's go over to find more patterns. So as you can see right here, this is a rising wedge. We just spotted another pattern here. So this is your rising wedge. As you can see, the market goes up, goes down, goes up, goes down, trying to squeeze out of its little channel. We marked out our trend line to the upside and to the downside, and then we're waiting for a break of structure or a breakout of the trend line. So this is where we got our breakout of the trend line around this point. So this candlestick broke below the trend line, and then this is where we enter for a short position because the market is about to go down. Now short position, stop loss around here, and take profit to the downside. This is our swing low. This point. This is where we're supposed to take our profits. As you can see, it's really played out well. The market goes up, making a rising wedge, and then broke the trend line. And then this is where we enter for a short position around this point. And then we waited for the market to go down. And as you can see right here, the market retested this place. Market goes down and then goes up again to retest. I don't know. So by the end of the day, the market goes down, smashing our take profits. So this is a rising wedge. This is the rising wedge I showed you, I was talking about. So now let's move over to find more patterns. As you can see right here, we have a head and shoulder. So the market goes up, there's a right shoulder, and there's a head, and this is the left shoulder. So this is your neckline. You can mark out your trend line. As you can see, this is your neckline. So this is the neckline. We waited for market to break below our neckline, and then as you can see, we are in the 1 hour time frame. And when we see this in the bigger time frame, this means the head and shoulder is really going to play out. So we go over to the smaller time frame to search for a break of this neckline or break of structure or something. And then when we see that, we can go over to take our short position. Stop loss above any recent high in the smaller time frame, and then take profit to the downside. So let's say we're targeting from this point. And as you can see, the market really played out well. Let's say this is where we targeted our take profits. As you can see, after the head and shoulders, within 1 hour, the market went straight to our take profits, as you can see. So this is called the head and shoulder pattern. And then after seeing this head and shoulders, we went over to the smaller time frame to take our trade. And then what happened? The market goes down straight to our take profit. So let's go over to Euro USD. So you see that these patterns do not just work for GBP USD, they work across all currency pairs. You can see these patterns across all these currency pairs, without the dollar index, Euro USD, BTC, gold. You can see them anywhere. So anywhere you see them, you can easily identify them. So now we are on Euro USD. And as you can see right here, I think we have a double top here. Take a look at this. This is Euro USD and this is the 1 hour time frame. Take a look at this. Goes up, goes down, goes up, creating equal highs, and then goes down. Now this is a double top. So this is where we mark out our trend line. So this is the neckline of the double top. So now this is where we enter a short position, go over to the smaller time frame, enter a short position, put your stop loss, and then take profit to the downside. You can put your take profit to the next swing low. This is your next swing low. So you can mark this out so you know where your take profit will be, and then take profit to this point. So as you can see right now, the market gave us a double top, and after giving us a double top, we entered a short position after the market broke the neckline of the double top. And this is where we wait for the market to go straight to our take profit, and even gave us small profit to the downside. As you can see, the market goes down after forming a double top. So this is how the double top really works. So let's go over and find more patterns. So as you can see right here, we have a pattern here. The market goes down, goes up, goes down, giving us a double bottom, and then goes up, breaking the neckline of the double bottom. How do we know this is a double bottom? Because we are seeing two equal lows. This is a low and this is a low, and they're both equal. So you mark out your trend line across the neckline. And as you can see what happened here, the market broke this trend line. The market broke your neckline and then retested it again to the downside. So the market goes up and then came down to retest it. So at this point, you can enter the market. You can wait for the retesting of the neckline, or you can just enter after the breakout. So when you see a double bottom, what do? Long position. This means the market is about to reverse. So stop loss below and then take profit to the upside. And as you can see, this is a nice trade. Market after breaking the neckline, market retested it, and then the market goes up, hitting our take profit. So this is how the double bottom works, and as you can see right now, the market went straight to our take profits. So let's find more patterns. So as you can see right here, the market, let's open this. As you can see right here, this is your bullish flag. This means the market is about to go up. You can literally see a flag from this point. Take a look. See? Looking like a flag. So this is your bullish flag because the market is about to go up. So wait for the breakout of the trend line. And now we got a breakout, and this is where we enter for a long position. Going over to the smaller time frame to look for the breakout. And when you see the breakout in the smaller time frame, this is where you enter for a long position. Stop loss above, below in the smaller time frame, and then take profit to the upside. As you can see, the market gave us these nice profits to the upside. How did we manage to catch this huge profit to the upside? This is because we saw the bullish flag pattern, and then we entered a long position. After we see our trend line breakout, this is where we entered a long position. So this is how the bullish flag works. The market simply goes up and then started consolidating to the downside, consolidated, and then broke out. Now this is where we entered, and we caught this nice profit to the upside. Now let's find one more pattern before we go. So as you can see right here, we have a clear, clean pattern here. Market goes down, right shoulder, head, and then left shoulder. This is our inverse head and shoulder. This is an inverse head and shoulder pattern, and this is where we mark out our trend line, saying, okay, once this market crosses this trend line, which is the neckline of the inverse head and shoulders, we say once the market crosses this line, this is where we enter for a buy position. And as you can see right here, the market broke the neckline and then retested the neckline again with this candlestick. And so this will enter a long position. Stop loss above the low in the smaller time frame, and then take profit to the upside. As you can see, the market gave us this huge profits. We can take our profits at this point. This can mark out the next swing high where we can take our profits. So we can raise our take profits up to this point. As you can see, the market gave us these nice profits. The market hit our TP. Why? Because we saw the inverse head and shoulders, and we waited for the breakout of the inverse head and shoulders. We had a breakout, and this is where we entered a long position, and then we waited for market to hit our TP. So this is how the inverse head and shoulder works. These are the few patterns you ought to know as a forex trader. And like I told you before, we have so many patterns. You can browse through your phone and you see the different patterns we have. But these patterns I've just given you are the popular patterns you ought to know as a forex trader. So whenever you see these patterns, they are the double top, the double bottom, the head and shoulders, inverse head and shoulders, rising wedge, falling wedge, bearish flag or bullish flag. When you see them, you can identify them and you should know what to do next. So if you're trading patterns, these are what you look out for, either the double top, the double bottom, head and shoulders, and the rest. So this is all for this video, and in my next video I'll be talking about market structure. So don't forget to subscribe, and I'll see you in the next video.